Howdy, Jacob here. Today we're looking at Quails, I believe, ticker symbol QLYS, company 100 of our high ROIC screener, software industry, 6.1 billion market cap on 5.6 billion enterprise value. Growth has been absolutely outstanding. Lowest revenue year over year growth was 12.9% the year of COVID. Return on invested capital, absolutely amazing, averaging out probably 20% or so, but most recent year, 43%, with gross margins of 80% and operating margin as high now as 29.4%. So they've been wild in the cloud-based platform delivering IT security and compliance solutions. Okay. Yeah, very, very amazed at this growth level here. Um, Shares haven't increased too much, and they've actually bought back since 2019. Balance sheet shows about 426 million cash on hand with 444 million total liabilities. So absolutely no worries on the balance sheet. They produce cash like crazy. Capital expenditures are actually lower now than they were 10 years ago, and they produce 5 times what they did on the cash from operations side. Their use of cash is probably, what do we see, in 20% or so reinvestment, a heavy amount of share repurchases. So that has been inflating their ROIC recently, as when you buy back shares, ROIC is based on balance sheet. And so a little bit of reinvestment, a little bit of share repurchase, or quite a bit of share repurchases. And let's make our own assumptions here. So revenue side, they've been growing like crazy. Me being fairly conservative and seeing that they went from 20% growth year over year, they've been doing 12%. I think personally, I feel most comfortable with 8%. This is why we all do our own analyses to come up with our own figures. But for me, I think 8% revenue growth year over year is something I'm comfortable with for the next 7 years. Margins have been going up, so I'll probably do the, and free cash flow margins have been substantially higher than earnings. I love to see that. So we're going to do a pretty wide range here, saying that income goes up and free cash flow margin stays relatively similar. So they get closer to merging, but they're still quite a bit different. Share change, I mean, they have been buying back shares recently, and it has, at least the last 4 years or so, outdone their stock based compensation. But 1% would be about a $60 million, which net of their stock-based compensation is reasonable. So let's do 1.5. That would be 90 million. They can definitely do that. That leaves about 50, 60 million, and this is just based on 1 year. Obviously, we're just doing a rough approximation here, but that should leave about 30, 40% of the free cash flow to use towards other purposes. P at an 8%. I mean, they're still growing like crazy. I think they'll still have quite a bit of growth ahead of them. They'll be looking like a less than $2 billion revenue company. Probably a 20P seems reasonable to me, 15% return. And yeah, it still needs to fall in half. Again, no surprise there. It's currently a 40P. I think a reasonable at the end of 7 years should be closer to 20, even with the heavy growth ahead of them. I think that that's reasonable to me, and definitely an interesting company, one that has a lot of growth. But again, it's not just about buying a good company; it's buying at the right price. I'd rather buy a business with very low growth but fantastic use of cash flow, with at a consistent 7P or so, than one that's high flyer growing 10% maybe at a 50P. So just keep in mind, it's not the business you're buying necessarily. Obviously, you want to buy a great business at the great price. That's best of both worlds. But every investment's present value, future cash flow. And here, I'm just not confident that the growth is going to outdo the current valuation. So hopefully, you enjoyed the video and have a great rest of your day. Thank you.